In honour of this special GC podcast, I'd like to pay tribute to one of the greatest GCs of all time, Paul Natoli, and all the GCs within the Grounded Construction Group, and all the GCs that have Sicilian building heritage all around the world. Grounded, making miners sleep better on your mine site. Get a Grounded camp now. Now! Righto, money miners. Oh, nothing like a round table that has been made possible by the fans. And we've got one of the OG best friends. And when we say friend of the show, Shawnee Russo, we really mean it. Not
Thank
like
you.
those other friends of the show. Repeat offender. And no better than, and we'll give context of why these two fellas are on. Oh, this is a moment in my life. Wait for it. Patrick from Uranium Twitter. You fucking beauty. He's on.
Hey, g'day.
How are you, mate?
I'm going well, thank you.
Oh, mate. Now, Mr. Ricardinho, give a bit of history of why these two fellas are on. Done by some great work by you guys, nothing by me.
Oh, they're legends who've, we put our director special out there with a bit of a stretch target. If you manage to get like 60 people to sign up with your referral code to our what we think is high value subscription to our daily email, then you get an invite to a podcast and also a dinner. So both Sean, Paddy, Alan Trench got there in our latest push, but Trenchy, also a former guest of the Potties, unfortunately can't make it today. But we're pretty pumped to have mate. Is this your first podcast appearance, Patrick, from Uranium Twitter?
Pretty much,
Yeah.
pretty much. I did one with what is it? Triangle Investor. He had another podcast with personalities from Twitter.
Yeah.
I did a short one with him.
Just while we're waiting, just for those who don't know, Patrick from Uranium Twitter, I'm going to play the clip of why he's called that. Here we go.
Maddie, on your point on contracting, there was a question from Patrick from Uranium Twitter.
Mate, how good was that? The first time
I like this guy.
someone introduced himself. It's from Twitter, from Uranium Twitter. That was awesome. Yeah. On a webcast.
I think it was on.
Yeah, that was me, John. Patrick here from Uranium Twitter. So, yeah, if you can let us know a little bit about contracting, any discussions you've had, that sort of thing, that'd be really great. Thanks.
Well, I can easily say we have had no discussions. There's no need to have any discussions until the utilities realise the predicament that is happening.
That was a momentous occasion in the history of conference calls, that was. And well done, Cobber.
Well done, Paddy.
Paddy, why don't you tell us a bit about, we've obviously had Shawnee on before. We know he's the team at Noah's Rule are the godfathers of hedging. Got a thumbs up from him then. Mate, what do you, we know you for uranium, but what else tickles your fancy in the world of markets?
I do like the tin stuff. I mean, I probably learned about that listening to you guys, to be honest. The tin trade, I've started to dabble into that. That looks a bit like the uranium trade back in sort of 2018, 2019. Other than that, I'm in a few sort of biotech stocks that I got into number of years ago from IPO. But to be honest, most of my portfolios, so I wouldn't say much, maybe half now, because I've trimmed at times. Half of it's probably uranium stocks at the moment.
What you just described to me, Paddy, is you are an official degenerate.
Yeah, pretty much. It's not going to work. But thankfully, as I was saying before the show started, I got in early. So people have to remember that, half my portfolio is in uranium, but I did get in very, very early. So
how early?
How
early? What year?
Oh, it would have been like 2018.
Yeah, right.
Oh, proper.
I discovered this trade like late 2017, early 2018, listening to, it might have been it was probably a combination of Mike Alkin, Rick Rule. There was a few guys talking about, there was a few podcasts, there was a few YouTube videos, and it just really piqued my interest at the time. And so I was watching it, and obviously it didn't work for those first couple of years. They sort of went sideways and down. I mean, Paladin probably trade around. This is before they consolidated the stock. It was probably trading, 10 to 20 cents and up to 21 and then back to 15 for about 2 years there before they sort of started to go on their rip in. It must have been the COVID lows of 2020. That's when uranium stocks started to move, really, because it was probably a pretty slow grind for the first couple of years.
How good were those old Mike Olkin shows that he used to? He used to do a fair few more of them. I remember listening to them, like 2019 and 2020, and just sort of being in awe.
Why didn't you buy any fucking uranium then, JD?
I did, mate.
Oh, did you?
Yeah, I sold them all in 22.
Oh, yeah.
So that was a little while
Very
ago.
nice.
So
Mike Alkin's done some cracking. Like he does a few here and there, but to be honest, the thesis has been talked about like so many times now. If you don't know it by now, if you haven't listened to 1,000 podcasts on it from Rick Rule and Mike Alkin, then there's plenty out there. They just don't need to do any more. But they still pop up every now and then.
So if you've been on this journey, Paddy, give us your take on things right now, because it sounds like forever everyone's been bloody bullish on it. Is it the same, different, just a bloody, a polished turd version of the same thing? Like, what do you think?
I think the trade still has legs. I just, that sort of supply side hasn't really been solved. We know where all the fresh pounds have come from. Most of it is just some restarts, and then you've got obviously Cameco and Kazatomprom that have restarted some stuff and got back to full capacity at some of their mines. But it's still. There's still a deficit, and there's been a deficit for years now, and it's probably not going away for several more years, maybe even another 4 or 5 years. So for me, nothing's really changed, and I just think there's these sort of like mini cycles within the bigger cycle that could well go for another 4 or 5 years from now, especially with the AI stuff and the demand side just picking up and the nuclear story just picking up. Now, none of that existed 6 years ago. None of it existed 4 years ago. So like the demand side keeps getting better and the supply side doesn't really get solved. So yeah, at the moment I remain pretty bullish. So most of my money's still in it. And if Paladin was to drop much more, or if you get another real sort of clean out, then I'd probably nibble a little bit more on some uranium stocks.
Sean, you're a wealth of knowledge when it comes to sort of mining history. Have you got sort of standout memories from that 2000 to 2010 type era in the uranium world? I know you said you hadn't done before the show too much hedging in that sort of space, but are there any sort of characteristics that we can kind of learn about or that stand out to you?
Yeah, thank you, because yes, I was just going to ask I want to ask the question about the Sprott Trust and Yellowcake and what people who understand this market more than I do. But to put it in context, yes, I remember in the 2000s boom, so pre-Fukushima, whatever, when uranium was running, and we heard that funds were buying uranium.
Hedge funds.
Yeah, hedge funds were buying uranium and putting them in caves somewhere. Like just literally buying
physical
barrels of physical and just taking it off the market and putting it. So they're creating a squeeze, which they love to do. And there's been, palladium in the past and various markets. There's been unbelievable hedge fund things where they've just altered supply demand by taking some off the market and then affecting the futures or whatever, and having unbelievable, like palladium, $100 to $1,000 type thing, all manipulated by Tiger. So we were hearing about this with uranium, thinking, oh right, okay, well. It's the same thing. So in the 2000s, my understanding is the uranium, that's what they did. And then, of course, at the right time, they just bring that all out. So my question is really, and there's a question more than a statement, is like what I'm looking at the moment at this whole Sprott Trust and Yellowcake is like people say, oh, this is fantastic because they just keep buying. So every time they're at a premium, they raise equity and they buy more. And people think some of this is sort of, it's like demand. But isn't it just overhang in the market at some point? Isn't it just supply that can come back at some point? I know the way it's set up at the moment, you can't redeem. Like the gold ETF, which I understand about, like in the gold ETF, you can own a whole lot of the gold ETF and you can turn up if you've got enough money and say, give me delivery, and they'll give you gold for your shares, right? at the moment in the uranium trust, you can't do that. You can't own a whole lot of the uranium trust and turn up and say, give me 10%. I own 10% of the trust, give me 10% of your pounds. Well, that's my understanding.
Yeah, and it's
But they
all
could change that in the future, right?
If it goes, at the moment, if it goes to a certain level and they have a shareholder vote, they could redeem it, but it's dependent on a shareholder vote. And I think that, what is it? Is it 50 or 75% they need to vote in favour for that to happen?
I am not sure, to be honest.
I think it's pretty high. It's like but it is possible. Like someone could take them over. Someone could offer a premium to buy all those pounds, subject to a shareholder vote.
Yeah, so if you look in like in the 2000s, something I am very familiar with is gold, right? And all of a sudden they start the gold ETF. Now, being able to buy gold is not new. Funds were always able to do it. But once the ETF was there, it was just much easier for funds to buy. You bought a share. And I remember going to the Indaba conference in 2010 or 2011. I wish I'd come up with this line. Paul Walker, wonderful guy, used to work at Goldfields Mineral Services, said, there's never been more gold one mouse click away from the market. You know, one of the things that's historically been the case is gold's a hassle. You own gold, you've got it buried in your backyard, you're up in a village up in Vietnam in the hills or whatever. You decide you want to sell gold. It's and by the time you think about it, you change your mind, right? Whereas he said now this ETF, and the volumes were huge in 11, 12. He said there's never been more gold one mouse click away from the market. Now in 2013, when gold collapsed and all the gold people cried foul, all that happened was that gold started to outperform general equities. And all the general equity owners that had some gold in their portfolio all probably went to an allocators meeting in the same quarter and went, let's get rid of our gold and go back to general equities. And they all click, 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 just sell the ETF. That was all there, right? Now, that's not necessarily there, but to the extent people own the SPUT trust, there's a lot of uranium now one click away from the market. Like if people want to get out of that and it can go to a big discount and maybe that's the thing. But I guess it just feels to me like, it's not the same as gold, but as that gets bigger, what impact does that have? Because at the moment it seems to help the market, sort of help spoof the market, but I just don't know what the impact of that is in the longer term.
I think it's being used as a mechanism at the moment, I think, and I've heard something about the fact that, and you'll be able to add a bit more colour, Patrick, maybe, but the old thing was you'd buy, spot was always cheaper than contract price for uranium, so they would buy spot at a lower price, sell the term.
It's a carry trade. Like
a carry trade. And I've heard there's something going on. I haven't been given the full info on it, where they're actually using the SPUT trust now when it's trading at a heavy discount, buying the SPUT trust and using that as the carry trade to then sell the term price. But then, which is... Yeah, I haven't got the full info, and that's like going to prevent it, whatever mechanism they then get out of it is going to prevent it actually going into positive to raise more capital to buy more pounds.
Right.
It's a recent thing, but I haven't got the full info. Take it away, Patrick.
I think SPUT's barely, like SPUT was really active when they first entered, which was like July 2021 or something. They were really active for like that first year. In the last, I would say, year or two, they've been barely active at all because they've been at a discount the entire time. So they've had this sort of flywheel at times when spot is ripping and, they're buying a few pounds, but there's such little in the spot market that they just can't really get the flywheel going at all.
Do you think they've got more, the equities or the traders and that have got more understanding and strategies in their arsenal now of how to deal with SPUT? Because it's been around a bit longer and manipulated in a way?
Potentially. I mean, who knows what's going on? I mean, there's people a lot smarter than I am in this trade. There's institutions involved. There's shorting. There's, regular just buying the stock. There's all sorts of stuff going on. I mean, who knows? I don't want to become a conspiracy theorist or anything, but
that's good for views.
But there's all sorts of I bet all sorts of strategies are in place to take advantage of SPUT when it's at a 10% discount or 15% discount at times. I mean, I don't know what the discount is right now.
I think it's close. It's nearly 10 again. Yeah,
What
it was
does
like
their-
they'll just raise in pounds
10%,
a couple
yeah.
of weeks.
What does the volume of SPUT? Does anyone know what the volumes of SPUT and yellow cake sort of represents as a percentage?
66 million
and-
pounds is SPUT.
Right, and what's that as annual supply? Like, how does that kind of work?
That would
About
be
a-
annual
about a
annual
third.
annual demands like 150, supplies about like annual demands like 180, 190, depends who you speak to, and supplies like 150, depends who you speak to.
So, and
again.
SPUT's got
That's a-
66.
Correct.
And what's
Yeah.
yellow cake got?
About a bit over 20.
Right, okay.
And
So
that doesn't include replacement rate, does it, Paddy? That's just supply,
Like new
reactor
demand.
supply.
Yeah, I
For
think
the
so. Yeah.
180. So I think they talk about in uranium, like there's what the reactors take, but then there's the replacement as well to keep the inventories and everything. So and you might be able to answer this. Is one you never get a straight answer on because notoriously yellow cake trades at a much bigger discount than SPUT. So because obviously yellow cake get their pound, they get $100 million US worth of uranium from Kazatomprom every year. That's how they get their increased inventory. Obviously, SPUT increases it by issuing new capital to activate the at-the-market facility to buy pounds.
Right.
But Yellowcake notoriously trades at a much bigger premium than SPUT. So, Paddy, do you reckon that is the case? Because, well, my theory was that people will be more inclined to buy SPUT to get them closer to raising capital, to buy more pounds, to lift the spot market, create a sentiment thing, where there's not as much of an incentive to buy Yellowcake because they're not going to buy more pounds. They've already got their fixed amount they get, fixed dollar
from
amount they get
Kazatomprom.
of Kazatomprom. What's your theory on it?
No, you're probably right. I guess, yeah. If you wanted to try and manipulate the spot market, then your first port of call would probably try to get SPUT back to a premium, so they can start issuing shares. Where you obviously can't do that with Yellowcake.
And
Does-
does Yellowcake, this might be a dumb question, but does that have a shelf life like some other commodities? It has to be used within a particular period. So, can they hold on to it for 5-10 years and it doesn't matter?
Well, I think, but I'm not sure if they can swap it or anything, because like when they hold it, like physically, like they will hold it
in barrels.
At a facility. So someone is holding that on
Yeah.
behalf of them. So it's not all in one, my understanding, it's not all just in one shed that's their shed. Like it'll be in friggin' North America or somewhere at one of the facilities, and they're holding that piece of uranium on behalf of that. So I'm not sure if they cycle the bits of uranium through or something. But it's not.
China's got like 600 million pounds or something, or 400 million pounds or something in storage. I think some of that's on the border with Kazakhstan and China.
Yeah.
And they're probably using a fraction of that each year. So I would imagine its shelf life is pretty good. It probably doesn't really.
It's not like bloody lithium hydroxide.
I mean, I'm not a
Yeah.
geologist, so I've got no idea, but I would imagine probably not. But
Let's run with it doesn't have an expiry date, GC.
Very cool.
I'm happy to be corrected.
I did get quite excited when with the Yellowcake when it first came out. I'd met the original MD of Yellowcake, whose name just escapes me a bit. He had worked previously for a kind of a high net worth that owned gold mines and stuff. So we had met him before. And I had a meeting with him when we were in London one time. And I said, oh, so you're going to be accumulating this uranium? I said, so you'd be like the central bank of uranium. So I said, the gold market, the whole hedge market works because there's uranium we could lend. So could we come to you and like borrow pounds, and then we could sell pounds in the market and raise finance for a uranium mine, and they would repay in uranium. So do like a uranium prepay like you do for gold, or we could do hedging because we could sell it and put the money on deposit in the future. And I'm going off like this, going, this is fantastic. We're going to, this is why, because particularly early market spreads are nice and wide and everything. I'm going, how do we do all this? And the guy goes, never going to happen. The whole idea of this thing is to lock this stuff up forever.
Want to squeeze the market?
Yeah, he goes like, why would we let those pounds go so someone could sell them? The whole idea is to take them over here. And I'm going, well, in the long run, that makes no sense. When he goes, it's an inflation hedge. It's a bit like gold. I go, well, I'm not sure it's like gold, but it was interesting because I got very excited about the potential, and I think at some point, it is interesting that to me, it's like, does someone take it over at some point? Do the utilities all get together and buy it? If there was a real squeeze, someone take this over and take it. So it doesn't seem to be as simple to me as I think the Sprott people try and it's like, it's good for because we're taking supply off the market, but they're not consuming it, so it's there anyway. It'll be fascinating. But
would unit
hedge
holders
funds are going to get into it at some point in a big way. There'll be some kind of
hedge funds
fantastic
already
trade.
are in a big way, and I think the hedge fund supply is actually somewhat separate from the SPUT supply. They might actually some hedge funds are set up to actually, participate in the physical market in a lot of ways. So there's the known SPUT quantities, but there's also like the hedge funds that have been participated for years and have set up kind of there.
And I think there's a lot of smaller people. Even Mike Olkin saying he owns physical. I think there's a lot of people that own physical on smaller scale. Shawnee, I'd be interested to and we talked about it the other week when you talk about supply and demand, like the comments around SPUT and uranium about supply squeeze, and you're having these trusts of people and storing uranium, and there's a supply demand model you can create based on reactors, the tail, and how much uranium is getting produced. What about gold supply and demand? How do you explain it?
We had an argument about this the other day.
Well, and it's no one. Is there a right answer? Is there if a shitload of new gold mines come online, can there be an oversupply of gold that can drop the price?
The context is my argument was that there's no extended period in history where the fucking fourth quartile cost producer makes excess margins for 12 months.
Yeah, so starting point for me is one of our greatest frustrations in dealing with our clients and trying to have a rational conversation with our clients about risk management. And our whole idea is I don't care how good that you think the market's going to be 3 years from now. Our job is to help you still be in business 3 years from now. That's how we look at it. So we go we got to help you get from there to there. And I'm looking at this next period of time. And so all of the charts that we always provide to our clients, we've got our scoring on the chart. And I'll use copper as an example, then I'll come back to gold. So we had a period of time post-2012 where copper went into decline. And so all of the backgrounds of all of our charts are red. We've got a negative weekly score. They're in decline. And we always say to our clients, when it's got a red background, you need to be urgent. Right? Gold's had a green background now for 104 weeks in Australian dollar terms. For the last 2 years, we've been saying to our clients, chill, do less. But back in this period of time, we were talking to clients. Now, we had a client where the managing director was the founder of the business, was quite influential in the business and the way things thought because he was the founder. And CRU was giving these very bullish forecasts based on supply demand of copper, right? And we were going, well, that's cool that they're doing that. But the background of the chart is red. The market is selling this thing. Every week we come in and it's lower than the last week. That's called a bear market. And when the background goes green and it matches the narrative, then we're happy to change our mind. But this is not us. This is our scoring system, which is non-emotive. It's red. It was like that for 3 years. For 3 years, CRU's going, this is a supply demand thing or whatever. And we're going, I don't know what's going on. And to your point about China's got all that stuff on the border of uranium, no one knows how much copper is sitting out of warehouse or off there or whatever. All we knew was the price was going down. So you can do all the supply demand analysis you like, but if the market's going down, maybe because hedge funds are shorting or whatever, there's no point standing in the way. The first thing you learn as an Australian kid is you go into the surf, don't swim against the rip. You will get exhausted before the rip runs out, right? Why do people not know this in the market? You go, if the current is going against you, swim to the side or let it take you, but do not go against it, right? There is no sense. So supply demand, we just all the time it's like consensus forecasts. We go, they're just a contraindicator most of the time, right? So copper, where you should be able to do it more reasonably, you can't. So come to gold. How can you? The only thing that you can rely on in gold is that gold producers will sell everything they produce every week.
Yeah.
And generally at the end of the quarter, they will sell more. They will squeeze the carbon out. They will squeeze every little bit of the process to sell more to try and hit their quarterly guidance, regardless of the price they achieve, because they've told the market they're going to produce that much volume, right? So we observe that the market is quite often soft into quarter end and then rallies, not all the time, but so you can rely on that. So you look at the gold market, the only thing you know with certainty is that annual production of the world supply is going to basically come out pretty much even 52 weeks, so that's even. But the mood of the market, people who want to buy, no one needs to buy gold. No one needs to buy gold any particular week. There's no one really that has to buy every week. Recently, we've seen central banks seem to be buying. Now, if you're a public servant and your boss has said, go and buy this much gold, You buy it every week, right? And regardless if the supply is there or not, you have to push the price higher if you've been told until you've got your fill. So central banks are wonderful when they're in there because they're this totally price insensitive kind of thing. And the only thing that happens is if they're trying to convert X% of their reserves, foreign exchange, if the price goes higher, they'll just get there faster, right? Because it was a dollar amount or a yen amount they were changing. So the thing that I observe with gold is that there's gold is this international market. Everyone thinks it's this huge market, right? It's everywhere in the world you go and everyone knows about it and it's quoted in every currency. It's like a junior stock. And we saw that last night. It's a perfect example, right? So we're talking this is, Tuesday of the first week after the election. The same thing happened when Biden was elected 4 years ago. Market held up and then everyone goes home on the weekend, assesses it, comes in on Monday and goes, sell gold. All the investors are selling gold and there's no buyers. The market's $100 lower before you find where the people in Asia or whatever want to buy it, right? So it's incredibly illiquid when the sentiment changes. So the idea of trying the Goldfields Mineral Services or the World Gold Council, like they for years always tried to do all that stuff about supply demand. And for 20 years, in my first 20 years of the market, the gold price went down nearly every year. Not every year, but almost. You couldn't do it on supply demand, right? You couldn't do it. It's the mood. But in the long run, you can do it. But in the short run, the only thing that's reliable is producers are going to sell. There's no reliability on the demand side.
And so in terms of like, say there's 10% extra production around the world or something like that, but if a central bank, like we've seen, decides that we need to buy more gold, does that just outweigh everything? Like how big is everything?
For the period of time they're there, if what they want to buy is as much or more than is going to be produced in that period, and overweighs any other kind of thing that's going on. Like 2013 is a great example. In 2013, when the price collapsed, it was because for 5 years previously, generalist investors had observed that gold was outperforming general equities. They have to own some gold in their portfolio. They don't know why gold's outperforming. They hate gold. But if gold is outperforming general equities, most general equity investors or asset allocators will allocate some amount to gold. Because otherwise, if they think their market's going down, what they should do is give their clients their money back, right? No one surrenders AUM, right? So what are you doing with your assets under management? You allocate them across to gold. In 2013, all we saw from late 2012 was the Dow Gold ratio or the S&P Gold ratio started to turn up and general equities were outperforming gold. And a whole lot of people over the last 5 years that had accumulated or bought gold all got a signal within 1 or 2 quarters it was time to go. And the gold price collapsed. And it collapsed because gold producers still had to sell. They had no choice unless they'd hedged. Like some of our clients had hedging, they didn't have to sell. Everyone had to sell and no one wanted to buy. And it was a bit like what we saw in Paladin today or Newmont a couple of weeks ago. When everyone's one way and then something happens to make it go the other way, the market shifts 25%. Every market does that because you just got to find a clearance price.
So
gold is no different.
Probably to your point, Trav, if say a shitload of new supply came on, but then you have one big macro change like that, it could fucking really magnify it sounds like you wouldn't think gold would be so volatile, but there's the potential it could be.
What I take away from Sean's point is like supply demand can actually, it has maybe not necessarily in gold because the demand's uncertain, but in the long term, there's like some predictability in supply demand models. In the short term, it's pretty fucking
what's that expression? In the long term, it's the market's a weighing machine. In the short term, it's a voting machine, right?
And if I relate that to gold, my point, and I'd love your retaliation, is commodity markets are not such that the very marginal producer should ever make super profits for a long period of time. Maybe you'll have price indiscriminate buying from a central bank, but a central bank will make the decision that they are going to buy X dollars of gold over a defined period of time, and once they finish, they stop. Yep. And then when they stop, what's stopping up the extra production that's come on the market? And that's the more like medium or long-term kind of outcome that I'm talking about. Very high-cost producers don't make really high margins, which they kind of currently are in the gold market, to be fair.
Yeah, they're making free cash flow.
They're making free cash flow, but they this time is special. I think this time is special, and we just shouldn't lose track of the sense that fourth quartile producers don't the times aren't fucking rosy for fourth quartile producers forever. In fact, it's kind of a short-term phenomenon. What would you say to that?
Yeah, in 2011, when the gold price really ran, I observed that everybody in the industry was making lots of money, and I was kind of I thought, and I hear all these old timers who go, the best hedge, of course, is to be in the lowest quartile. That's the thing. And you go, well, but if you're in the lowest quartile and everyone's making money, then that's just going to bring on, high prices. Nothing cures high prices faster than high prices. This is when you should hedge. If you're in the lowest quartile and it gets to a point that everyone's producing, why let the bottom feeders have a go? Why not just sit on the market and lock in extraordinary profits? And it went from 1,800 back to 1,100. My thesis would have been perfectly correct. The people who had but the reason they didn't is because all those people had only recently spent an enormous amount of shareholders' money buying all their really bad hedges back in the late 1990s, which was nothing to do with shareholders and all about keeping their jobs, right? So in the mid-2000s, we actually had that situation that they were all spending shareholders' money to buy back, new shareholders' money to buy back. So no one was courageous enough to do that. But really, in any market, to your point, if everybody is making profits, even the lowest quarter, that's when the top quarter guy should go, well, this is when I should really just make hay, right? I should just lock in these margins because I know these margins can't last because nothing cures high prices faster than high prices.
I'll give you the best indication of where the gold market is. My mate that isn't involved in mining too much sent me a message about, how's all-in sustaining costs, or what's the cost to get an ounce of gold out? So I rang him up. I said, what's a bit of context? He says, look, we're just in my mum was up in Northern Territory. We were up in Northern Territory with my mum the other week, and we went to the Mount Todd gold mine. And we were getting asked about it, and they're trying to get it back going. I said, mate, that is the best indication that the gold price is high. That's getting talked about.
The Rick Rule metric.
Stoidus said.
Stoidus, sorry. You're 100% right.
Yeah, so interesting. Mate, Paddy, should we get you on some bloody uranium-specific equities? We'd love to hear how you unpack a lot of these, and I would love to hear it. Personally, I'm going rogue here. Do we want to feel free to bloody tie these two in together at some point?
Fire away.
Paladin today, mate. Big news. Down, I think it was 28% by the end after another 11% from the quarterly back. And Trav clearly highlighted that they've still got debt in the capital structure after being at an $18 share price, didn't raise money, and now they're bloody $6.80. Take us through the pre, the current, and the post. What do you think the post might be?
Where do I start?
Oh, emotional? Are you a ding?
Emotional? I am a shareholder. So,
ding.
As I said earlier, I mean, obviously when your stock drops 28%, you get a bit frustrated. But when you've been through that a few times, and as I said before, you started recording, we've had all these little mini cycles within the broader cycle for the uranium trade, which has been going on now for probably in earnest for 5 years. It started on the 2020 COVID lows, and Paladin was probably around the 10 cent mark. Some people would have got in around the 10 cent mark. And obviously it ripped all the way up to 17, which pre-consolidation is like $1.70 in the old if you use the pre-consolidation price. So what's that? That's 17x on your money. That's not bad. And if you sold a bit up there, you're not doing too badly. And if you didn't sell up there, I just wonder what people were thinking. Not at least trimming a little bit when it was $17, because there was obvious risk. When a mine is going from development into production, we've seen it so many times with all sorts of commodity stocks on the ASX. That's a really challenging period for them.
I'd love to know, Sean, like we had the debate on the podcast today, which you wouldn't have had time to listen to by the time coming in today, but I'm pretty critical of Paladin for putting $150 million of debt in their capital structure, which they did in January. Share price is 40% lower now. Now they're having ramp up issues. And I argue that they are a marginal producer by definition of the fact that that supply went offline in the bear market. And I just think, like, when you're priced for perfection, why the fuck did you put debt in your capital structure instead of just like putting equity in there with minimal dilution? what are your thoughts on that?
And probably to add to that too, we've sort of conversely in the gold market, admittedly at a much more junior end, seen certain companies who have, seen their share price at, all-time or near all-time highs, who had debt or had debt arrangements in place, very quickly replace that with equity at those higher prices to remove that. So I'll just add that to Trav's question as well.
The example that I know you're thinking about in the gold is a very interesting one. We can come back to that, maybe.
Maker and Black Hat.
Look, we've helped mining companies borrow $3 billion in sort of $50 to $150 million chunks. So we've been involved in a lot of financings of mines, base metals, all sorts of things. One that does come to mind, I won't. The stock was Mirabella, and we had done a bit of work, and they had gone from 20 cents to $6, and we were there, and they were looking to engage us as a debt advisor to get debt and hedging. And at the time, nickel was in backwardation. So it's always harder to hedge something that's lower in the future. Contango sort of makes you feel better. It's not necessarily better, but it makes you feel better. And I remember saying to the company at the time, why the hell do you want to hire us? Because they said the Canadians guys have said it could raise this money 3 times over. And I was like, I'm going to talk myself out of a job, but if I was you, I'd just take the equity. This is a hassle. This is such a hassle to get this debt and the time it's going to take and the hoops we're going to jump through and the hedging we're going to do. But if you want to do it, I'm happy to help. We're the right people to help you. But if I was in your shoes, I don't know why you would, right? And that stock ended up at 2 cents. The mine didn't work, so that's a different thing. But at the time,
if they had equity,
these guys
they wouldn't be a 2 cent
These guys
stock.
did incredibly well, and they probably took some along the way, and they're all doing very well. They don't have full-time jobs anymore, so so they did okay out of it, right? But it was that thing of but when you've seen it run like that, and everyone's telling you it's just going to keep on going, but it doesn't. Nothing cures high prices faster than high prices. That whole nickel run from 10 to 50 was extraordinary, right? Extraordinary, but. Yeah, so that was a perfect case where you do the numbers and you just go, you should just raise equity. You should just do it with equity. And I think my view generally is that mining companies and debt really don't belong together. And that's why we're in the hedging advisory business, because our thing has always been that hedging and debt are necessary bedfellows. If you're a junior miner, in particular if you're a single commodity company in your portfolio, I've seen so many people, balance sheets and capital structures devastated by a fall in the commodity price who had debt and no hedging. So I would stay away from it. So, if you've got a really strong share price, why not raise equity? Now, it's a different story if you can't raise equity.
Yes.
If you can't raise equity, then you go to the bank and the bank says, have I got a deal for you? But when your share price is very strong, I never kind of understand that. I do get it. People have got MBAs. I don't have an MBA, so I probably suffer from not really understanding, the whole efficient market hypothesis and whatever else they want to look at. But you look at it and you just go, I can see how it looks better in your spreadsheet, but it's a spreadsheet. And mines and spreadsheets are like worlds apart. That's the biggest problem, I think. Excel's probably the worst thing ever happened to mining in many ways because it makes mines look really simple. But I would be with you. Why would they do that? And I stay away unless I have a very bullish view on the equity and want to express that view. Then you'd go to the geared company with no hedging, right? But what I do know is if you have hedging, if you have no hedging and you have debt and things start to look bad, the short sellers love you. In 2013, the companies that got absolutely poleaxed, the gold companies, were the ones that had debt and no hedging.
Yeah.
Because short sellers are looking for zeros, right? That's what they were looking for, companies that go to zero. And gold's never going to zero, but gold companies that have debt and no hedging, or copper companies or uranium companies, they go to zero all the time, right? So, debt and no hedging just attracts the shorts. Why would you bother if you can raise equity at a sensible price? And so Mika, who I think you were referring to before, I think we shared between ourselves, and happy to talk more publicly now because I think it's fantastic, the outcome. I looked at that debt when they announced it, and to my eye, it was the most expensive project financing that any Australian company would have done since the 1980s.
Pretty big IRR.
It was extraordinary, right? But you don't have to have my experience or your experience to understand that. Clearly, I would imagine that lots of shareholders of the company also did the analysis and suggested to the company that it probably wasn't a very good idea, and particularly with their share price being stronger, it made perfect sense. So I applaud the company for backing out, because often people get to that, they don't. So I
Like,
absolutely.
I've finished it, I might as well go through.
We've done it, and there's probably a break fee or whatever else, and it's all too hard, and we've done all this work. So I absolutely applaud that company for going that far and then going, whoa, hold everything, and raising the equity. But when they started that process, I think their share price was 2 cents.
Yeah.
Right? So when they started that debt process, that was logical. It was the right thing to do for shareholders. And if having to announce that deal was the catalyst to actually get people to say, hey, I'll pay more for your stock than that if you want to raise it and get it done, then well done them, right? Well done them. But when the world changes, you have to change the view. And that's one of the things we've been criticised a couple of times, not criticised, but like we've gone into a process with the client and said, this is what we're going to do. And then we get halfway through the process and you go, we've got to change everything. They say, why? Because the outside world just changed. Like if the outside world changes, you have to change your view. You don't want to do what you were doing anymore. And I think that's what Mika did. And I don't follow Paladin closely, but I don't have any understanding why they would have debt at that.
Yeah, that was a really weird one, because at the time I can recall when they put that debt facility in place, it was around January. I mean, correct me if I'm wrong, but January, that's when the spot was like 107, 106. The equities were ripping. The value, I mean, their market cap would have been like 2, 3, 4 billion, who knows? They could have raised 10%. That they would have been so cashed up and beautiful, wouldn't have to stress about anything. But instead they take a debt facility for what, 100 million US or whatever it is.
150, 95 drawn. 150. Yeah.
Very odd. Yeah, I don't know.
Who was the lender?
So it was a consortium. There was Macquarie, Nedbank, maybe ING was on it as well. But yeah, there were
banks.
There were banks. Yeah, banks.
What were the banks thinking? Bloody hell.
Well, the banks are thinking they get security. They get security.
$3 billion market cap, and if he gets into trouble, you'll just raise equity and repay me. So yeah,
and even like Paladin's been a distressed company in the past for balance sheet woes, and if you had security of the asset, you still made off like bandits.
No, I don't. Maybe they're just crazy U-balls as well.
So, Pat, if you combine the debt and feel free to give your take on the processing and water woes there. I guess, do you think they're going to be forced to raise DOSH, or really at risk of having to do so?
Well, that's the question, isn't it? I suppose. I mean, they had 55 million at the last quarter, end of the last quarter, plus 55 million debt facility still that they can access. I don't know. I mean, though I think they were negative cash flow still for the last quarter, but it wasn't a massive amount. I think one of the notes I got sent to me was that recoveries had improved a bit this month. So for the quarter, obviously, it didn't look great, the recoveries and their costs and everything, but apparently that has turned around a little bit. Obviously, we've got to wait another quarter before we can see whether that's actually a reality or not. But I would also just add, like, the spot market has not done what a lot of people thought it would do. I mean, it hit 107 and it's just sort of ticked lower and lower on really low volume, almost illiquid. At one point it dropped, I think, $2 on no volume, just someone dropping the bid.
Yeah.
And that's the really bizarre thing about the uranium spot market, is that it can just move with no liquidity, no one buying anything, and it'll drop a couple of bucks.
And I think, and the fact that the spot price currently is sitting just above the floors of what contracts are getting written at. So you got floors of 70, ceilings of 130, and spots at 77. Like, it's pretty close.
And terms 81.50, right? As reported at the end of the last month. So almost that carry trade's almost back as well. There's about $4-5 of carry trade you can buy in the spot market if you can get it, and then put it into a term contract at 81, 82.
Do Paladin have long-term fixed price offtake contracts?
Yeah, I think it said that. It said today they'd utilised most of the flex in their contracts.
Right.
Along the lines, it sounds like as if they hit their 3 million, the bottom end of guidance, it sounds like that'll cover the contracts. I think if they'd miss the 3 million, there might be a risk they have to go buy from the spot market, but it's a bit opaque.
So that's why the banks then would be happy to lend them on the basis they do essentially have hedging. Not with the banks, but they have certain revenue, because that's what the banks are always looking for. Like in the model they want, in the spreadsheet, they want that certain price in there that makes all their ratios tick. So that's fine. Your issue, as you say, is if you're not then producing it for less than that, it's a problem.
It goes the other way quickly because
this
is
the other thing, is that, when it does change, and we've seen some examples recently in the market here where people have had to raise equity to repay debt or reduce their debt to lenders, and part of that's because if it doesn't work like the model, then the bank will be the first people to recut the model and say, well, on this basis, actually, you can't carry the debt that you have to carry. And that's when you do have to then go back to the equity market and raise equity to reduce debt to bring it back in line the bank's thing. There'll be a bit of grace on that. But it's always, again, you've just got a whole lot of people telling you how to run your business who don't understand mining and just driving everything off a spreadsheet. So every time you can avoid having a bank in there, the better, right?
I blame Ellie for this because she made the model of the example you're talking about.
You're never going to live that down, are you? I wonder how. I think
a young analyst.
I think maybe personal relationships between MDs might be come into play because there's uranium companies that have inventory, like working capital inventories of uranium sitting on it. So instead of buying from the spot market to fill their contracts, they might be able to borrow it off another uranium company. If they get along, who knows?
Sean, you've got a pretty unique perspective in your role on the decisions that management teams make regarding sort of risk in their business. And we sort of touched on this before we started recording today, but what are the key characteristics or sort of features of a management team that you see in your gig of people that run a business that treat it like owners versus those that treat it like, it's a salary job?
Yeah, cool. Thank you. Good question. So like 84 to 2004, I worked for Rothschild. Rothschild was like back in the day, like what Macquarie does now, and how you see Macquarie being one of those finances, a junior miner and whatever, the midwife at the birth of many good junior companies. We were like a midwife of junior companies as well, right, in the day. And so and it was all about identifying good people. I think one of my bosses briefly, when we were dealing with, a more colourful West Australian mining entrepreneur, my boss said, Sean, doesn't matter, the asset doesn't know who owns it, right? But you learn pretty quickly in lending to mining companies that it is not asset-based lending, right? The worst mistake you can make in lending to mining companies is imagining that asset-based lending. It's all cash flow lending, because mines are worth nothing if you can't produce the commodity profitably, right? Whatever. So management is everything, because good management can make an average asset sing. Bad management can take a really good asset and screw it up, as I'm sure, Matty, you have sort of seen in your working life or whatever.
Done it with my own hands.
Assuming you thought you were good management in the first place, but yes.
No, I wasn't management. I just literally fucked it down there. Yeah.
So the point is, like, over that 20 years that I was at Rothschild, what I observed was people who behaved like an owner in the business and were worried about cash flow, and were worried about the longevity of the business and the ongoing, that business, they succeeded through the cycle. And the guys that were all about the commodity price and were predictors of things, some of them ended up roosters and lots of them ended up feather dusters, right? Like it's just heads I win, tails you lose with the shareholders' money, right?
Yeah.
But the guys that were there, and so one of my kind of heroes, if you like, through the 1980s, 90s was, in terms of looking at people who did well, was Robert de Crespigny, who built a big business in a down market. And one of the reasons that he always hedged, and he always had like certainty, because he's an accountant, so he was driven by like I've got to know what my costs are. I got to know what the margins are. I've got to be able to survive. And if I survive here, I remember someone saying to him right near the bottom, well, what if gold's going out of fashion? And it was very common in the late 90s for people to say gold is, it's the barbarous relic, it's whatever. And he said, look, if in 5,000 history of gold, I happen to have been born and want to be a gold miner in the time where gold loses relevance, that's on me. But I don't think that's the case. I think there's life of gold. So I've just got to stay in business until the market turns around, right? And so when I first started the business, my original business partner in Noah's Rule, I said to him, what we do, what we want to do, our message will resonate with people who behave like owners and not like operators. And I think in Perth, I meet mostly people, even if they're not significant shareholders, and some of our clients have been very substantial shareholders of their company. If they behave like an owner, you can see in the way they do things, and they're still here in the longevity, and they think about cash flow and they want to hedge, and they say to shareholders, I know you don't like hedging and I know you don't like giving up the upside, but you rent this stock. Like you're using this to rent an exposure to gold. You could be gone tomorrow. I'm committed for the next 5 years to build a business in Africa, in Perth, in Western Australia. I'm going to behave like that. When I went to North America, we did one really good project financing in North America for a company called Atlantic that Sir Barbara took over. And we believed it was the shining example of how you could use hedging to do things differently in North America. Naively thought, right, I'm going to go to North America and I'm going to show these guys how they can do things differently. And we just got our ass handed to them. We came home, like it was no point. But in Toronto, I met people who, in my observation, were all agents. They were optioned up and it was heads I win, tails you lose. Whereas in Vancouver, you meet people that behave more like owners because it's more the entrepreneurial market. It's the smaller. So Vancouver and Perth are very similar. And in my observation and my experience, Toronto and Melbourne are very similar. The further you are from the mine or the kind of thing, the bigger the disaster. There's been lots of disasters out of St Kilda Road, right? In Melbourne, companies that just kind of the management think they know what they're doing. So for us in our business, it's been very important. Like we're having our 20th birthday on Thursday night. And we got
Happy birthday, sure.
Thank you.
And Noah's team.
Yeah, and we're very excited. The whole team's coming over. 8 of us will be there, and we've got about 120, 130 people coming, and I've got to give a small speech. And, our business plan when we started was do good work for good people. And that's all we've done for the last 20 years. And, I think, the good people is really what it's all about. And to your point, it's about people who behave like they're an owner, even if they're not a substantial shareholder.
Do you need an MC for the party or?
No one is taking that microphone out of my hand, Eddie. My business, my microphone. I'm not paying for the drinks for 130 people, having someone else tell the jokes. But thank you for offering.
No worries. I was going to charge you. Speaking of good assets and high salaries, Patrick, Nexgen, go.
Yeah, I bought some Nexgen the other day. Well, not the other day. I think I bought it on the pullback. I like Nexgen. I think at some point, it's such an awesome asset. At some point, it will be developed, but the $1 million question is when. And
who?
Yeah.
Well, this is the perfect company to talk about after what Sean just said.
Does the asset know who owns it at Nexgen?
Well,
It's actually interesting. It strangely,
Trav, you are very interested in Nexgen at the moment.
I want to do an episode on it. Addy.
Discovered by an Aussie bloke too.
Discovered by an Aussie bloke. Have been very public in my critique of that management team. Think that they stand for everything that I dislike about our industry, and can objectively point to instances of that over time.
You don't like Formula One.
They actually own a lot of as a result of their strategy to, maybe As a result of their strategy, they happen to own a fair chunk of the company now. Which might actually incentivize them to act like owners it's a very strange thing to think about.
I'll say,
paying yourself extortionate stock options over time, they actually own a fair chunk of the company.
Yeah.
How much do they own?
Lee would be worth $50.
Yeah. What's who do you think's going to buy it? Do you think they're going to develop it?
That's super interesting. Like Paladin trying to get their hands on Fission's project, which is like right next door. I don't know. I mean, I don't think they're going to build it because it just seems so complicated. And I don't think they have the expertise. Obviously, Lee Courier could probably employ people to do it, but there's so few people in the uranium industry. It's going to be difficult to do that. I think the smart thing to do would probably just be sell it at some point, in the next couple of years to a Cameco or even a Paladin. We'll see what happens, but someone else who then develops it.
How are they going? Can they sell it without selling's different to getting taken over? I guess.
Yeah. Yeah, well, who knows? I mean, if they get a good offer, they'll sell. I mean, shareholders would love to be taken out at some point.
I'm sure they've been given some.
If
offers?
spot was to rip like back to all-time highs 107, and then maybe it marches towards 120, 130, there'll be more M&A for sure. There's already been a fair bit. I think there's going to be more. I don't think that's going to stop.
Why isn't there any as much now? Like Paladin Fission, obviously, but I guess you've got Jabiluka and Nexgen. They're the jewels in the crown for uranium. And we've seen what's happening possibly with Jabiluka. Nexgen's it's the standout not on a operational front. It's obviously it's in a fucking cold area and it's deep and it's extremely high grade, which may present some challenges, but it is the highest grade, highest quality ore body in the world that will produce the most per year of any uranium mine.
I feel like the only company that has any experience that could figure out how to do it is probably Cameco.
So Cameco Orano JV, similar to the other ones.
Do they have underground, sort of super deep underground in an icy, wonderland as well? I mean, it's super niche sort of mining, I would think. I just feel like Cameco would be the only ones that could make it work. It would be they'd be the logical developer, in my opinion.
So, but do you think it'd be the same structure as like Cigar Lake, whereas like Cameco are the operator, but it's the JV arrangement with Orano to do it? Or do you think Cameco will go 100%?
Potentially. Who knows? That's I don't know. I mean, yeah, it could be. It could well be Orano getting involved as well. That would make sense as well.
Because they need something after getting kicked out of Niger.
Yeah.
Can they fund it? Because they had to take out $300 million bond issue the other day, didn't they? So
Orano, yeah. But could Cameco fund 100% of
Scrip. It's not a state-owned company. It's Scrip. Yeah.
Oh, but no, but then fund the development of it.
Fund the yeah.
So it's like
Development,
the JV thing might be a
project finance. Yeah.
I'm going to offer a slightly different, just a broader perspective that at the moment, broad commodities are underperforming equities to the worst extent, general equities to the worst extent ever in the last 125 years, right? Probably longer, but we only got data going back to 1900. No one gives a shit about commodities in the world. That's the reality. It's so easy to make money in general equities. It's so easy to just be long the index, to be long the S&P, to be long the Dow, to be long whatever. That there's not worth adventuring over into all these other spaces. So we all operate in this space and we love it and we all get very excited about mining. But like the whole market capitalization of every mining company in the world is 2/5 of F-all, right? And so we need for it not to be so easy to make money in general equities. We need like right now, it's like 98 or 1999, where you kind of go, it's coming, but then you have another 2 years of the equity market just going nuts, like a melt up or whatever they're talking about now in general equities. But 98 and 99, like mining just sunk. Everything was a disaster. Aussies at 50. And then 4 or 5 years later, the whole world's changed, right? But what happened is the dot-com bubble burst or it rolled over and people went, oh, okay. And, you guys worked in the asset world and you look at it's all about relative value. It's all about going from one sector to another. And when one sector's outperforming, like all of a sudden Bitcoin's outperforming gold comes off, Bitcoin goes up, everyone chases whatever's hot if that's the pair you're looking at. I think for this uranium stuff, for everything, like for mining generally, until general equities actually rolls over and then some of that money comes across this tiny little market, won't take very much to create the emphasis, and then the appetite will be there to do deals and share prices will be high enough to attract more money. I mean, in many cases at the moment, the problem you have is the market capitalizations of most mining companies are not large enough to let a lot of the world's largest investors even invest in them. They can't even invest because the market cap's below some level. One of the things that I think is going to be really exciting when we have a mining boom, and we will have another mining boom because we're underinvested in resources dramatically, is that just as people in the business who actually think they understand how mining companies are valued, just when companies get to the point where you go, oh, that company's overvalued, it'll just be getting on the radar of some generalist investor who's now decided he needs an exposure to mining goes, oh, its market cap's more than 2 billion. We can now invest, right? And before you know it, it'll have a market cap of 4 billion. And we'll all be going, what went on? But until that money comes across, no one cares. This is the problem that we have. No one really cares about our sector fully. Specialists do, but the broader market could care less.
I didn't even see one of the major banks. It would have been like last week or the week before they put out this report on how funds are sitting. Are they overweight, underweight? Resources, commodities, things like that. And it was just in every instance so underweight, especially these are more the generalist ones, so underweight commodities and resources. It's just ridiculous. And as you say, Sean, when that time comes, it'll just be on.
Just hold on, Ali, your small cap
Oh,
portfolio. Won't know what's happened to
it. But it kind of makes sense. Like, people have been asking me the question for the last couple of years, you look at gold. Well, gold's going up. Why aren't gold shares going up? You go, well, gold's going up because gold's going up. But the people, and the glib answer is, well, the people who buy gold don't buy gold shares. It's not in their mandate, right? So it's as simple as that.
Exploration companies.
And that's right, and all the ones I own. But you look and you go, they should be linked, and at some point they probably will. But the reality is, if central banks are buying gold, and Asians and Indians and other people who want to buy gold are buying gold, and people are buying gold for that reason, they're buying gold. And the only time, if you're I had this wonderful expression that just keeps rattling around my head, and there's so many applications. I was talking to a client recently, and I said to him, you should hedge your gold, but if you do hedge your gold, you should hedge the fuel as well. And he goes, what? And give my boss 2 reasons to sack me. Now the gold oil ratio is at 35. It's perfectly logical that you should be you should selling gold and buying fuel. Gold oil ratio is nuts, right? At best in 120 years. But I love it. He goes, it's 2 reasons to sack me. Well, if you're a generalist investor and you buy some gold, that's fine. But if you buy gold equities and gold equities aren't even outperforming gold, just giving your investors another reason to take their money back. So until commodities and all the other risks associated with them, including management and whatever else, and geography, look at Resolute, the political risk. Just while gold is going on a tear, why buy gold equities if you can just buy gold? And in fact, why buy gold if you can buy general equities, which is your mandate? But gold has been outperforming general equities. So we need a massive, someone's got to jump on the other end of the seesaw, and then all of a sudden we take off. But on that Goldman Sachs Commodities Index versus S&P, the Goering and Rosenzweig guys publishing whatever, we've been in a 10 or 12 year downtrend. Our time is coming, but it's like watching paint dry waiting for the turn.
But I've never thought about it that way. The people who are buying gold and making that gold price go up, they don't give a shit about gold exploration stocks. They're 2 different sets of people. I've never sort of thought about it.
Yeah, it's just a totally different group of people, and they're buying gold and they're making money. Japanese people looking to protect themselves from a weakening yen. They're not buying gold stocks. They're just buying gold. They're going down the shop. They're buying gold. And so at some point, the gap has to close. But to do that, gold producers actually have to not let their costs run up as fast as the gold price, and that's part of the problem. All of a sudden, people are talking about $2,500 and $28 all-in sustaining costs, with a straight face. It wasn't above that price.
Yeah, well, 3,000 is going to be the new 2,000.
Oh. Have you got any other?
60 is the new 40. I mean, I agree. There's an element of that where you have to have those views, Matty. But it's a bit different.
I thought it was your 20th birthday on Thursday.
Have you got any other sort of contra indicators from your clients? Not to throw them under the bus, but are there trends you've noticed 20 years in the business now that we might be at inflection point? Might be a bit grandiose, but are there signs?
Not amongst the owners.
Very good. Very good.
Actually, Pat, I've got a question for you. This is completely left field from what we've been discussing today, but the world of MinTwits and Twitter. So, for context, I had never used Twitter before until 3-4 months ago. I think it was basically a precondition of my employment.
Not for me.
And I have to say, it is completely just baffled me, just this MinTwit world of just having access to insights of people who you don't necessarily have to be, the traditional, fund manager and, with a commerce degree and a this and that, but people providing really interesting insights that's, available to everybody. But then you've got, schoolboys kicking each other in the nuts, arguing over something stupid, and then memes. Like, talk me through that. How did you sort of get involved in that world? Why do you love that world so much?
I actually got Twitter. I probably first got Twitter like maybe 10 years ago, and then I didn't use it for like probably 6 years. And then it was around the time I started researching the uranium trade that I think I probably jumped onto Twitter at the same time. Maybe someone said, oh, there's this guy you should follow. Maybe it was Quakes or something like that. And then you start, sharing a few tweets and you're doing a bit of research, and more people have come to Twitter, I feel like, and this is probably not just commodities, but probably all sorts of niche industries. I feel like Twitter is just this just melting pot of people from industry and sell side and buy side and retail investors and sophisticated investors and all sorts of people that just come here to just chat about whatever it is that they're invested in. And uranium Twitter specifically has been an awesome place to just get information off some really smart people. Fund managers will get back to you super quick. It's just, it's been incredible journey. And I mean, I had a few hundred followers back in 2020, and now I've got like 9,000. Most of them are just uranium degenerates, but that's fine because it's just super fun to be on there, and you learn so much. But a lot of stuff gets repeated as well on there. But it's a good place to be.
So many of the fund managers on there under pseudonyms, or they're mostly on there as their name, or
I think like Art Hyde shares a lot of stuff. There's obviously Uranium Insider, Justin Hune, everyone knows who he is. There's John Quakes, who remains a mystery man. No one knows who he is, but he just shares info.
Fucking shares some pretty bloody. He's obviously got some good connections because he's got some early shit coming out.
I don't know how he tweets that much and that often. It's just incredible. He must have automated something. But then there's guys like heaps of guys that just do their own research and build their own spreadsheets, and they've got like spot versus long-term price versus medium-term price plotted out over the last 4 years, and they've got spreadsheets on everything, and it can be shared between people pretty easily on Twitter. So
I had a phone call today, Paddy, with a Twitter like pseudonymous person who only has a couple hundred followers, and I actually have a different view to him on a thing, but had a call with him, and it turns out he fucking works for he works for either Millennium or Citadel, don't know which one, but one of the two. He's clearly managing fucking billions of dollars. So
How do you, Paddy, with your like uranium specific, like yours specific, but it applies to any bloody commodity? How do you, I guess, scour Twitter for the information for people that you don't follow? Like, what's your most efficient way of getting all the info in your lap, or you just scroll the living fuck out of it?
It's just. There's certain people I follow that have provided a lot of good information over the years, and they tweet good stuff, and they have specific sort of information that they share, and I follow those guys. But hashtag uranium, and you can pretty much find anything you need.
Mate, have you got any? What's tickling the whistle at the moment in the world of uranium that we haven't talked about that might have been a bit left field?
I just feel like it's been talked about to death. Just need the spot price to start moving again. I don't know.
Just make that happen, everyone.
It'll happen eventually. It just at the moment it's not happening for whatever reason. But I remain committed to the trade and optimistic. So we'll see what happens. You just need sentiment to turn, and maybe there's Paladin stuff today. Maybe that will be the turning point. We will see.
Very good. What are we going to finish up on?
I got one for you, Sean. It's like in the aftermath of Trump, gold's sold off substantially. Is this a short term kind of reaction, or is there sort of substance to the gold sell off?
Gold's in a bull market. This it was hot. Running in, it was very, very hot. our scoring that can only go to 6. It was in the high 5s on both the daily and weekly basis, so everyone was long. The interesting thing was we sent a note out called Coin Toss to our clients a couple of weeks ago, and we showed the 6 weeks before and the 6 months after the last 2 elections. And the interesting thing was actually in the case of the Biden, so Trump, we had an 8% move on the day, Trump's original thing. So the common wisdom before Trump was elected, and I had a meeting that will be burned in my memory forever where somebody else was advising one of our clients. We were in a room and we were saying we thought they should hedge, and Aussie dollar gold was around 1,800 and it made perfect sense for them to hedge. And this guy goes, oh, no, you shouldn't hedge because what if we have a black swan event like Donald Trump becomes president? And I said, well, it can't be a black swan event. It's a 2-horse race. But anyway, put that to one side. Who says it's going to go up? Well, everyone says it's going to go up. Like that was the common knowledge ahead of Trump was if Trump becomes president, gold's going to go nuts. Well, by the end of his 4 years, it had gone nuts. But on the day that it was announced, it was 8% on the day and it finished almost unchanged. And by the time it was inaugurated, it was lower. And 2 years after he'd been in office, it still hadn't made new highs, right? Interestingly, with Biden, what happened was there was no on the day, when Biden got in, made it to the weekend, was up a little bit. And then just like last night, $100 off on the Monday. And for the next 6 weeks, it just petered off and it ended up being $200 lower. Aussie dollar gold was 600 lower because if you remember, Biden was going to be very good for the relations with China and very good for the Aussie. So the Aussie went up about 5 or 6 cents. So Aussie went up, gold came off, alligator jaws closed for Aussie dollar gold, and we shed $600 in between the election and Christmas. Now, that doesn't look like that's the case today. We don't see the Aussie going madly away. But this is a correction in a bull market in our view by our measure. Our weekly score is still very strong. It's the averages all look good. Like gold looks good and gold is still outperforming general equities for the last 4 or 5 years. Like I've been really big on 16 on the Dow. I like to follow the Dow gold ratio, still in the 16, 17. So it's still all right. But I think a bit of hot money's run back, to other markets. Like somebody said to me the other day, I think you said copper. I can't believe copper got sold off on the election. I heard on one of the podcasts. And it actually not about copper. It's about someone wants to own something else more. You know what I mean? Like, so they're not actually saying, I think I don't want to own copper because of Trump. They just go, well, I've only got this much money from my investors and I need to get longer. I
need to get in Bitcoin.
I need to get longer Bitcoin. I need to get longer general equities. I've got to sell some copper. So it's quite often the case that if you're fascinated by one market, you get bent out of shape when it goes down. You can't believe the idiots that are selling it, but they're buying something that you don't understand.
To be honest, I've never thought of it from that way.
Everything is a relative trade. Every sell is a buy, right? There's no money on the sidelines. Like it's, because the money had to come in on the other side, right? It's just which bucket people choose to put their money in. And I think gold is still one of the least smelly buckets. And I'm not going to say it's dangerous in my line of work to actually say how bullish, where I think the gold price could go. But I mean, I think the gold price could be much higher in the future. I have no problem with that. But I also think it could probably be lower before it gets there than most people imagine as well, right? Like that's the thing. And one of the things we are trying to get our clients to do is stop thinking in hundreds or dollars per ounce and start thinking in percentage terms, because now we're getting into numbers where it's really dangerous to think about $100. $100 is just like that, but it's not a big percentage move, right?
It was like $50 at 12.
Yeah. You've got to start thinking in percentage terms. You've got to start thinking about how your margin relates in that and how far it can move. Because 20% move from here now, like when we look at where people are starting to talk about all-in sustaining costs, 20% move from here, and it starts to get pretty squeezy, right? So, but a 20% retracement is just healthy.
Yeah, I like that explanation, because in future now, if we can't understand why something's gone up or down, I'll be like, well, obviously the fucking money went elsewhere.
Yeah.
And I've got the
Flow of
explanation
funds,
sorted.
Matty.
Flow of funds.
There were more sellers than buyers.
I learned that very early on when I went to I used to go to the meetings when I first started at Rothschild, and I had no idea what was going on. I couldn't remember the gold price from one day to the next, and someone did, like war had, this is like 1984, and war had flared up in the Middle East. And I had this boss who just didn't give a shit. He was an expat, and he just was he was making such good money, he didn't care what his day job was. But someone said to him, like, why has the gold price gone down? He goes, selling gold to buy missiles.
Fair enough.
Was probably true.
Very last question, Sean. Every year you gift your people you've worked with over the year a book.
Yep.
It's quite a thoughtful book. What's it going to be in 2025?
I cannot, as much as I'm very honoured to be a friend of the show, and it is not revealed. It will be revealed when it arrives. One's coming for your bookcase. We actually drafted the letter, finished the letter today. The book has been chosen. It's a fabulous book.
Is it a new book or an old book?
It's a relatively new book. I loved every minute of reading it, and I listened to the
Chairman's
author read it. Well, it's not the Chairman's Lounge, well, that's a good read too. I saw Joe Aston speak the other day.
That was a cracker.
He's just. I wanted him to actually write in my book to Double Bay Jesus. I'm getting off track now, but I said to him, Double Bay Jesus is still my favourite. And he goes, oh my God, that could be my next book.
Yeah, I heard the exact same interview.
He said the unofficial, all right, so did he say something about that? Because that's, like, I said to him in the signing.
Somebody said, what's next?
Right.
And he said, the prospects of writing a biography on Double Bay Jesus sounds quite appealing.
All right. Well, I think I might have given him that idea. I hope he gave me credit for it. But the funny thing was, and I said, I've got a working title for it. I said, stay in your lane. And he said, he can never do that. I said, exactly. He's always telling people what to do. Just because you're a billionaire, you shouldn't give advice. But no, so the book is a secret, but it's a particularly good book. The guy has written a very good book in the past. It's an awesome read. The forward is by Neil Ferguson. That's all I'll say. And I've said in the letter, if you don't like the book or you don't think the book's going to be for you, if you read the forward and you can't read the book, I can't help you.
Did Neil write? Did he write?
The Ascent of Money.
He's written a whole lot of books. He was, by far, he is the best ever. Diggers does lots of good things, but they're very bad at choosing keynote speakers. But without doubt in my mind, Neil Ferguson, when he spoke at Diggers, has been the best keynote speaker ever. He's a very interesting guy. So he wrote the forward. It's a great book. Yours should be arriving shortly. It's but I can't reveal.
I'll save a guess for offline.
Very good. Right, Patrick from Uranium Twitter. It's been an absolute pleasure, good sir. Can I finish off with the uranium underrated overrated?
What was that?
Can I do a finish off with the uranium underrated overrated?
Oh yeah, okay.
I'll
yeah,
just hammer you, hey?
Easy.
Well, needless to say, Paladin.
Underrated. 30% fall. How can that not be underrated? You gotta nibble a little bit.
Boss Energy.
Probably say underrated as well. And Boss, they've had a bit of a pullback too.
Bannerman.
Yeah, they're one of my biggest holdings. So
Ooh, interesting.
I'd probably say underrated.
Deep Yellow.
Underrated.
Elevate.
They're all going to be underrated.
I'm sensing a theme here.
Any of them overrated?
Okay. Toro Energy.
Overrated.
Oh God, that's the only one I own.
Cauldron. Ding, ding, ding.
Cauldron, I would say underrated just based on, you compare Toro with CXU. They're both sort of in WA. They're both development projects. They both need the lifting of the ban in WA. And I think Toro, last I checked, could be wrong. That was about 30, 40 mil market cap. CXU is like 20. So I just figure, the last few years they've sort of tracked each other. So at the moment, I would say CXU is a little bit underrated.
Aura Energy.
Aura Energy. That one I haven't particularly liked at all. I probably won't go into detail, but I would say overrated. There's been some issues with stuff about them. You can go into that on Twitter and do some searches and stuff.
Interesting. Nexgen. I think you know this one.
Nexgen, I'd just like neutral maybe, I suppose.
I've got one. JB's long lost son, the Twitter profile.
Oh, that's a good one. I speak to that guy a bit, actually. He's not too bad.
I love the profile picture. It's great.
Cameco.
Well, it's outperforming.
Considering the Westinghouse exposure.
Yeah, I guess I don't know. It's outperforming everything, and it probably should because it's the gorilla in the room. So probably neutral on it, but hard to know if Cameco needs to come down or everything else needs to come up a bit. Neutral.
Considering it's 0.3 cents ERA.
Yeah, no. Not touching that.
You're the ever optimist, Matty, but that's a donut.
If it was a donut, it'd be trading at 0.2.
It's a wonderful thing about a share at 0.3. It can still fall 100%.
Kazatomprom. The free flow.
I'd probably say neutral on Kazatomprom and Cameco, same sort of thing.
Global Atomic.
The US names I don't know a lot about, but no, I wouldn't touch West Africa. Just as a rule, I wouldn't touch that. It's a bit too crazy.
I'll leave them ones out. That's been a pleasure for me, ripping an overrated, underrated, because I never contribute to it at all.
Cheers, Matty.
Right, it's been a pleasure, mate. Shawnee Russo, thanks as always, mate. Always captivated by your history. Just absolutely love it.
Pleasure to be here.
Beauty.
Thanks, Paddy. Hoodaroo, guys.
Nice to meet you, Paddy.
Hoodaroo.
Thank you. Cheers, Sean. Thanks, guys.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.